Michael Ashton is joining us, the managing principal at Enduring Investments, aka the Inflation Guy. Mike, this is an interesting morning here because you and I have been talking about this now for a couple years, and this inflationary trend to the upside seems like it is firming, if not getting a little hot. Am I wrong?
Yeah, Oliver, look at this. This is my deer in the headlights look. Okay, that's what's going to happen at the Federal Reserve next week. The scary part about today's number, and really last month too, was there wasn't really one thing that was sort of sticking out. It wasn't that you just got used cars or you got, shelter took a surprising jump or something. It was, it's core X shelter went to the highest level since 2013, and core goods jumping quite a bit. So and core goods going up with the dollar stronger on the year too. So there's a lot to not like here.
So, Michael, when we are looking at 2.4, right? I mean, highest of the cycle, less food and energy since this recovery began, and now you've got a tough choice coming up. Well, we know that the bond market's been signaling needs for cuts. There's this little kind of reflationary trade the past week. I mean, look, you just tell me where to go here, because what I want to know, and what I think everybody wants to know is it real this time, right? When everybody thinks inflation is dead and we're putting it on the cover of magazines, are we rising at a little bit of a juncture?
Well, I think that we're certainly going to find out from the Federal Reserve if the whole risk management framework that they talked about last time is really what they're operating with, or if they're, if they really do care about inflation. You've got growth here in the U.S. that's still okay. It's fading, but it's still okay. But you've got shipping costs, going up. You've got wages that are going up. You've got tariffs. All those things are still upward pressure. You've got lower interest rates and high and volatile stock prices that are pushing, pushing.
Yeah, new highs today. Yeah.
But that's kind of, there isn't a whole lot of downward pressure yet. I mean, I sort of expect inflation to peak later this quarter, or more likely early next year. But I also didn't expect we to get 3.3s on core in a row.
So this is what's important, right? Is that there's a few sections of this that are stronger than others, right? Food and energy still kind of trending down a little bit. You mentioned the core goods. It seems to me like you're putting more emphasis on the core goods part of it. Tell us why, for those that aren't the inflation experts and are trying to figure this out. What's the most compelling evidence within here that this is not just a aberration?
Yeah, well, to some extent, we've been expecting core goods to rise for a while, just because of the delayed effects of the weaker dollar a couple of years ago. But we sort of thought it would peak at maybe 0.5% or so. So this month, year on year, core goods went from 0.4%, so inflating, to 0.8, and that's a pretty big jump in a single month. Over the last 5 years or so, we've been accustomed to goods deflation, and if we suddenly turn that around to inflation, within core goods, you have stuff like pharmaceutical prices that are, suddenly jumped last month, that had gone down for a while, and maybe they're finally reverting to the mean. The most disturbing thing here is that there's no one disturbing thing.
Now, Michael, is there a potential with some of the gains in consumer items, personal goods, footwear, things like that? Are those the volatile ones where if, let's say, there's some market event, or let's say there is a real recession that doesn't go away, let's say the trade deal goes sour next month and people get paranoid, I mean, is that the component that could then flip lower and suddenly we go, oh, this was just a, brief peak of consumer activity we saw?
Yeah, that's possible. You have to keep in mind that, footwear, miscellaneous personal goods, those were two of the top gainers this month. But they're tiny in terms of the amount of dollars we spend on them. And so, affecting, core CPI or affecting CPI, it's not big enough to matter. So, they could flip. I think miscellaneous personal goods, it was up at a 50% annualized rate this last month. That seems a little excessive. Even if that reverts to the mean, it's just not going to make that much of a difference.
Okay. And Michael, one of the charts that you brought to us that you put together using Bloomberg data is this inflationary component here in the U.S. looking at compared to the Baltic Dry Index. Now, we're getting pretty nerdy here on some of these measurements. I know that whenever there's a Baltic Dry chart, then I'm already over my head. So, but this thing's been moving, right? I mean, how much credence do you take in this? Because this was put on our radar by a guest a couple weeks back when it started to really pick up some steam.
Yeah, the hard part about the dry index is that it's not entirely clear whether this is cause or effect. If the value of the goods that you're shipping go up, then the shipping prices also tend to go up. So, if you're shipping, paper clips, it's much different than if you're shipping raw pharmaceuticals or something like that. So, but look, this is one of the inputs. Shipping costs are not a huge component of the end product price in the United States, but it does matter, and especially if you're competing domestically, if you're a domestic producer and you're competing with goods from overseas. The fact that it's more expensive to ship those goods from overseas is going to matter. That gives you a little more flexibility if you're a domestic producer to scooch prices up a little bit as well.
One other thing here, Mike, when we take the inflation component that looks strong today and we tie it to the last couple employment reports, I like that, as you pointed out on your Twitter feed, look, this has been kind of picking up for a little bit. The wages have also been firming and showing some decent surprises, a basis point here or there on the last few employment reports, regardless of the headline number. So you put those together, and that looks like a little bit of a trend to warmer spending activity inflation. But some of the other GDP revisions lately have been getting revised downward. How do we think about these two kind of forces?
Yeah, I think, from an inflation standpoint, the interesting part, I think that everyone's gotten the whole Phillips thing wrong. Clearly wages are accelerating because we have low unemployment, and that's good for American consumers, who are the ones working. That doesn't necessarily translate directly. If you look at the chart that you just put up, if that should make you really disturbed about inflation if you were a pure Phillips curve kind of person and you thought wages go directly into prices. But the other thing we've got margins, equity, stock margins that are at near long-term highs, over 10% for the S&P 500 average profit margin, and that means that businesses have room to absorb these higher wage costs, bid up for the workers they need, and not necessarily raise prices immediately or as much. So that's why the Phillips curve, as people talk about it, why end inflation hasn't responded as much as you would think from the low unemployment rate. In terms of overall growth, it helps that the consumer is doing better. And look, tariffs, protectionism, it's called that because it protects the domestic market, and it protects domestic laborers.
Right.
And so that's one of the reasons that we're the cleanest dirty shirt right now.
So, Mike, the last thing here is, do we know how much of the stronger inflation number, especially given your point about some of the core goods? I know that shipping costs via the Baltic Dry chart suggests some upward pressure, lower interest rates, negative bonds, and possibly stock prices contribute downward pressure. I'm just reading from your notes here on the way you view some of these playing out. So the conclusion on tariffs then is what? Upward pressure right now, but if those come off, do we expect inflation to go lower?
Yeah, so there's two things here. So one is the direct effect of higher tariffs. And before today, I didn't really think we had seen that much in the CPI, and I really didn't think we were going to necessarily see it. That would show up mostly in core goods. But it's a short-term effect. 1 year from now, if we don't change the tariffs, then that effect goes away. But also, if we lower them, then you'll get a short-term downward effect. But the real longer-term problem is that we have now sort of a fractious global trade debate. we're no longer kind of all on the same page, and everyone's looking to take advantage of the U.S. Share in the gains of trade. So now we're fighting over those crumbs, and at the end of the day, that means that going forward, we're going to have a worse trade-off of growth and inflation than we've become accustomed to during the last 20 years of trade liberalization.
Michael, great work here this morning. Best take yet from the inflation guy. What a day. A little comedy mixed in there, too. Michael Ashton, appreciate it. Really good work helping us sort through the numbers. Definitely going to be an interesting week ahead for the Fed.